Welcome back to Quant Forge. On this channel, we test trading strategies with real data, real Python code, and real backtests. Because financial YouTube has already suffered enough from people drawing triangles on charts with complete confidence. Last time, MACD was surprisingly respectable. So today we're testing another legendary indicator, Bollinger Bands. And if you've ever watched trading content online, you've probably heard somebody confidently say, price touched the lower band, massive reversal incoming, which sounds very scientific. So naturally, we're going to test whether this actually works on Bitcoin. The strategy is simple. We buy Bitcoin whenever price closes below the lower Bollinger Band, and we sell whenever price closes above the upper Bollinger Band. That's it. No leverage, no machine learning, no AI institutional smart money quantum flow detection, just pure mean reversion. Basically, buy weakness and sell strength, Imam, which sounds reasonable. Until Bitcoin enters one of its weekly, let's move 20% for absolutely no reason phases. We start with $10,000 and test the strategy on Bitcoin data going back to 2019. First, we download the Bitcoin price data directly from Yahoo Finance. Then we calculate the Bollinger Bands themselves. The orange line in the middle is a moving average, and the upper and lower bands expand whenever volatility increases. The idea is simple. If Bitcoin falls too far below the lower band, it may be oversold. And if it pushes too far above the upper band, it may be overextended, at least according to people selling trading courses. Next, we generate the actual buy and sell signals automatically using Python. And honestly, this strategy already feels slightly concerning because instead of following trends like MACD, Bollinger Bands constantly tries to fight momentum and bet on reversals, which is kind of like standing in front of a freight train because statistically it should slow down soon. So now it's time for the real test. We run the full back test and compare the Bollinger Band strategy directly against simply buying and holding Bitcoin. And honestly, this thing got absolutely annihilated. $10,000 invested into Bitcoin grew to more than $211,000. Meanwhile, the Bollinger Band strategy barely reached around $12,000, which is honestly impressive, not financially, but academically. At several points, Bitcoin was going nearly vertical, and the strategy basically responded with, this rally seems emotionally excessive. Now, to be fair, the strategy did slightly reduce drawdowns. Buy and hold suffered a brutal maximum drawdown of roughly minus 77%. Meanwhile, the Bollinger strategy reduced that to around minus 62%, which is technically better, but sacrificing almost $200,000 of upside to reduce drawdown slightly is probably not what most investors had in mind. Next, we optimize the Bollinger Band settings. Instead of only using the default 20-period setup, we tested multiple combinations automatically using Python, and the best performing version actually used a 30-period window with a 3 standard deviation band. That improved the final portfolio value to around $33,000, which is definitely better than the default version. Although at this point, better is being used very generously, and honestly, this result makes sense because Bitcoin is not really a calm, mean reverting asset. It spends massive amounts of time doing the exact opposite of what mean reversion strategies want it to do, which explains why Bollinger Band struggled so badly here. So compared to RSI and MACD, this was probably the weakest strategy we've tested so far. Still, this is exactly why backtesting matters, because many trading indicators sound brilliant in theory, right until real market data arrives and starts throwing chairs. Anyway, this is exactly what we do here on Quant Forge. We test trading ideas objectively and let the data decide what survives.